because you believe that covered call is a hedge strategy. It's not. Covered call has unlimited downside risk. I'll give you an example. I used to do it on futures. So I used to buy futures and sell calls. But let's say the future, so 16,800 maybe Nifty is trading at, and you sell a call for 50 rupees. So the moment you start trading below 16,750, you start making loss on the future or cash, whatever it is. You're losing money. So covered call is a strategy that's made out to be a risk-free and savior for all to make consistent money on your portfolio and all. That is bullshit. That actually is not a very good strategy, and definitely not a one for beginners. It's a ticking time bomb. It's just a matter of time when it will go off. And one more thing, again, let us come back to this strategy. And if market blasts to the upside, now this 50 rupee call is trading at 150 or 200. Now, to make sure that you make all this profit, you have to let go of your futures. Now, selling futures is no big deal. But if this is cash, you have to let go of your cash portfolio, because cash profit is notional profit. It's a notional profit. It's not an actual profit. But loss in the calls is an actual loss. So whatever capital you have kept aside for selling calls, this loss will be taken out from that. But this cash profit won't be added back. You have to sell your shares to book that profit. So it's a nightmare strategy especially if you are a beginner. I would not at all advise you go even close to that.